Well, given the recent market volatility associated with the global COVID-19 pandemic, I wanted to talk a little bit about risk. I want to talk about risk in a multi-part series. Part one is a primer. I think most of us in the asset management industry understand these concepts, but this will make sure that we're on the same page when we discuss going forward. Now, if we look at the official definition of risk, we get a definition like the effect of uncertainty on objectives. Now, if we were to ask a lay person on the street, what is risk? We might get an answer something like the possibility of something bad happening or the possibility of injury or damage. In the investment management business, probably talking about the possibility of losses. Now, if we're going to be uh, more proper about the definition of risk, we're talking about a measure of dispersion. That is a measure of how dispersed outcomes can be given kind of an expected return. Typically, we're talking about this in standard deviation terms. We're also talking about it in annualized terms, regardless of whether or not the instrument is going to be around for a year. We could be talking about an option, in which case it might expire in 90 days, but we're still going to measure risk in annualized terms. Importantly, risk measures both good and bad outcomes, both positive and negative outcomes when we're talking about standard deviations. And of course, this risk varies by asset class. If you think about government securities like treasuries, you think about certificates of deposit, you think about money market mutual funds, you basically get the promised interest payment on those types of vehicles. There's very little likelihood of any kind of deviation there. You think about corporate bonds, you think about investment grade versus below investment grade bonds. There's certainly price changes in those instruments, and so the dispersion of return can vary. You also think about stocks, then there's even more dispersion among the returns there, very high positive returns, very low negative returns. These outcomes vary by asset class. So the more dispersed those outcomes can be, the more risky that asset is. We also talk about risk using various measures. Think about the traditional CAPM beta. It's a measure of volatility versus a benchmark. Think about risk, which is kind of a measure of the market in general. Think about R squared, which is a measure of correlation versus a market. And in my world, we're often thinking about active risk. This gives us a sense of like how different could we be than our benchmark. And again, this active risk number is a measure of standard deviation. So if we think about an active risk of 4, then that tells us, we're going to be, between negative 4 versus our benchmark to positive 4 versus our benchmark, kind of that 2 standard deviation window. So 68% of the time we're expecting to be in that negative 4 to positive 4 versus our benchmark. That's kind of just a real basic primer on risk. Next time, I want to talk about uncertainty and complacency in a way that's directly tied to the way we were acting both before and after this global pandemic started. Thank you so much for listening, and enjoy the rest of your day.